Hey everyone, Josh Martinez here, and welcome to this week's idea. So this week's idea is gold futures on a 1 hour time frame. So let's get started. So the market is making higher highs and higher lows, and the buyers are currently in control. And we were to draw our trend lines going backwards, trying to find the most common area of known level of U-turn. What we discover is that this market is bouncing at, on, and or and around this blue level. So what this does is this separates the market into what's called a buy zone and into a sell zone. So anything above this blue line is the buy zone. Anything below this blue line is the sell zone. So low-hanging setup, right? Low-hanging fruit here would be just to see, well, can the market come near the uptrend line and then bounce bullish and rally towards the north? So if so, fantastic. We kind of know there's a buying opportunity there. It doesn't guarantee that the market will go up. The market could absolutely reverse and break into the sell zone, but as long as the buyers are above that blue line, momentum is considered bullish. Now, what we could do and what we will do is put on our one-click fibs starting from this lowest point of this trend and working our way up. And what this will do is this will give us our Fibonacci sequence to kind of help us with the best stop and the best limit. So according to the Fibonacci's, we do have a fresh 1-2 boundary. We just recently hit this Fibonacci extension. We touched the green retracement of the 886, making the extension the green 112. So to kind of give you an idea of what that could have been worth, well, let's just go ahead and take a look to see if we go back and enable risk versus reward. Not saying that you would have done this, but if you would have bought the exact low, not saying you would have, but exact low, the reward was 5,069 ticks or $50,690 with a full contract on gold futures. The first Fibonacci would have yielded $47,610, assuming max opportunity. Now, the risk here you can see is 21,510 on the first Fibonacci. Second Fibonacci is $7,720. So big risk, big reward if we get it right. Now, if you were to buy right now, the risk is $58,150. The reward $29,280. So basically, you're risking 5,800 ticks to make 2,930 ticks, give or take. So what do we do in this particular scenario? Well, there's a couple things you could do. You could just say, screw it, let's do it, and just place the trade. Place your stop where it's supposed to go, which is 4643.8. Place your limit where it's supposed to go, which is 5518.2, and let the thing do its thing. The second thing that you could do is you could just simply wait for the market to retrace near that uptrend line, and when or if the market goes near that trend line, if you find a U-turn, take action. You have smaller risk, bigger reward, which is great. But if you're kind of looking at this, you're like, there's no possible way. This is, even if the market does retrace, this just doesn't logically make sense. Well, then what you'd want to do, or a idea, because I can't tell you what to do, right? Because I'm not a financial advisor, I'm not a CTA, I'm just an educator. A good idea would be just go to a smaller time frame, go to a 5-minute time frame. On the 5-minute time frame, apply your uptrend, right? Look for where the market U-turns the most, and when or if, not saying it will, but when or if the market retraces at, on, and or around one of these blue levels, then go to take action. Start scalping the market. Scalping is really straightforward. All you'd really be doing is this, right? You would just say, hey, I acknowledge for whatever reason the market U-turns at, on, and or around this hypothetical blue level. You are going to be risk adverse, so you're not just going to guess U-turns. You're going to say, I'm going to buy on confirmation. You will then wait for the market to break and close above the purple line, indicating that the short-term retracement is over, right? And the long-term extension could begin. In this hypothetical scenario, we'll go to our trade panel, and then we'll just simply press the buy button. We'll place our stop in the sell zone, so we'll just move the stop to the sell zone, And then we'll go after the bullish point. The bullish point is just like a new high, right? And if the reward is bigger than the risk, you let the thing do its thing. And the reason why you wait for a counter trend line to be broken is because the goal would be as soon as you enter into the trade, the market goes your way right away. Bingo, bango, trade is done. Now, is it like that every single time? No, I wish it was. As we know, there's risk involved in trading and so on and so forth. However, could we try to do that again? Yeah, of course we could try to do that again. Trading is about making the decision on how you want to trade. For me, it's about monitoring patterns, acknowledging long-term direction, going to smaller time frames for smaller risks to try to get smaller rewards and take little pieces at a time. So what would be a decent setup? Well, a setup would just simply be let the market retrace, not saying it is, but it could, and if it does retrace, bring in another counter trend line break, apply my favorite entry strategy on the way up, try to get a logical, repeatable stop in the opposite zone that where I want to buy. So if these blue levels are pushing the market up, then I just simply want my stop, which is an automatic exit below these blue levels, because I want that blue level to be my friend, not my enemy, okay? So once again, for gold futures, 1 hour time frame, we're in an uptrend. We are making higher highs and higher lows. Buyers are in control. We do have a target at 5518.2, which is now like 2,850 ticks above the market. We could just rally now, or the market could retrace for a deeper retracement and then rally. If you don't want to place the stop at 4643.8, according to the Fibonacci rules off the 1 hour time frame, you can always go to the smaller time frame as long as the market stays in the buy zone. Look to buy low, your favorite entry strategies. If you go to tradingview.com and you go to search the names and you look at my name, Joshua Martinez, all one word, no spaces, no dashes, no numbers. What you can do is you can look at these posted ideas. So what I do is when I have these ideas, I will then post them online. You will then begin to see my write-ups, my stops, my limits, my outlines. You get direct access, which is fantastic. What I really, really like about this stuff is that you have like this before and after. So you have this little play button. So here's like a silver where we go, hey, there's 294 ticks to be had here. You can press play and you kind of see what the market does after I post it. So you can kind of hold me accountable on, hey, is Josh actually good or is he not good? So which I think is always very important. All right, everyone, that concludes this week's idea. My name is Josh Martinez. I appreciate the opportunity. There is risk involved when it comes to trading. You should never invest money you cannot afford to lose. Always keep risk management in mind. Understand that we are not CTAs, which stands for Commodity Trading Advisors. What that means, what I'm going to share with you is research. What you do with this information is completely up to you. Past performance is not indicative of future results. What that means is there are no guarantees, absolutes, or 100%. Trading does involve risk. If you're not comfortable with the risk, do not be a trader because it's all about managing risk. What else? Look at us like a newspaper. We'll share with you our research. We'll walk you through our findings, but what you do with this information is completely up to you. I am not a CTA. I'm not a financial advisor. I'm not a money manager, so I will not dictate your trades, and I will not collect money to trade on your behalf. That's not what we do. Hey, everyone, have a wonderful day, and we'll see you next time.